The market has been in a bit of a panic over the last month or so, and I've been talking about it quite a bit, not only because it's a huge topic in this space, but also because this doesn't happen all the time. I mean, sometimes when we're in a downturn, it feels like it lasts forever, but if we zoom out, we talk historically. Historically, we're almost always moving up, and that's great, but it's not always as important because when things are going up, it's easy to just hold, forget about it. When things are going down, that's when real mistakes can happen. And like I said, I've covered a lot on this channel, but mainly, well, one, it's harder to cover single stocks when stocks are in a free fall. It's like, okay, if I'm like, hey, I like the stock, yeah, but it might get slaughtered in the next month or two because we're in a bear market. That's hard to do. So it's easier for me to cover these sort of things, but it's important to also understand when a market downturn is happening. It's not always fun. It's not good to, check your portfolio, you're down X% again today, or you don't even check it that day, you check it the next day when we're up a little bit, and then you notice how much you're down still. It's not always fun. However, it's important to understand that if markets were always moving up, that's not necessarily a good thing. Now, yes, technically, if we zoom out, we move up historically, 9 to 12%, depending on what metric you want to use, what time frame, how conservative versus optimistic you want to look at it, but somewhere in that 9 to 12% is pretty sober, pretty realistic, and anything outside of that might be a little bit too extreme, at least for me. But you can say that 9 to 12%. Yeah, you could say maybe I just want to go up 9 to 12% every single year. I'm happy with that. That's just not how the world works. Yes, historically, you will fall within that threshold. That's what we've done over 40 years, 20 years, many metrics. You're going to find that rate of return. However, that's just not how the stock market works. You're going to have years where you're up 30%. You're going to have years where you're down 10. You're going to be up 2%, basically flat. You're going to be down 40. That's just how the stock market works. And if we think about it, if we never truly went down, we never had any pullbacks, we just went up 10 to 12% or more. That means if you think about it, people would know that. People would take advantage of it. They would leverage themselves. They'd over leverage themselves. And that would lead to inflated price. At the end of the day, when we think about it, we have to have stocks tied to something meaningful. And that meaningful was the company's actual performances. Yeah, theoretically, if companies can improve 30% every year, that would be awesome. Stocks would go up 30%. Imagine all the money the rest of the world would be making. Ideally, the products would be incredible as well. There'd be great job, things like that. Yeah, that's awesome to think of. That's not how it works at this point. We can't get companies that grow 30%. And at the end of the day, our VEO and every other stock we own, even though sometimes things move different, some stocks are valued a little bit more based on how much they make, how much they grow, and some less. And we're trying to find the balance in that. We're trying to exploit that sometimes in single stocks. It is very, very important that our stocks are tied to something actual, and that is the earnings and the growth of actual companies. We want our stocks tied to reality. Now, what I'm not saying is we don't want to buy a stock, let's say around 15 PE, and hope that it goes up to 30, because then we double that and then get whatever growth on top. That is totally fine. That is normal. That is reasonable. That happens in the stock market all the time. I'm not saying you can't wish for that, but what I am saying is we do want our valuations of our stocks tied to something meaningful and real in the company's performance. We want that. And the reality of the world we live in is not every year of even great companies is good. Great companies have terrible years. They have mediocre years. They don't perform well for a number of years. Sometimes that is how the world works, because not everything goes our way. There's bad market conditions. There's plenty of things that can happen. Meta is the perfect example of this. Hindsight is 2020. I'm not inventing that phrase, but it is very much true. Meta, 5-year performance. Yes, we've seen higher 5-year performances, but for a company this size, and from what happened, this 300% is truly spectacular, right? 2020, 300%, whatever. But in 2021, we were at 378. We fell all the way under, I believe it hit in the 80s, but at least we can see here, it was low, 88. It hit that. It fell from 370 to 88. Everyone had them for dead, and then it proceeded to run from 88. It hit 730. That is truly spectacular. Now, what was happening is they were having a horrible year. No one believed in them. Their PE was something like 12, and even that was coming off of terrible earnings that were not at all reflective of the future and what was actually happening. So in hindsight, we can say, okay, that was clearly an opportunity to buy, but this is a great company. I mean, you don't have to like what they do. They're a $1.5 trillion company. They're up 300% in 5 years. If we're being objective, your feelings aside, this is a great company. And this is a great company that had a horrible, horrible, horrible 2-year stretch in a, year and a half to 2-year stretch in a time period where the market was out on everything. Now, this was an extreme reaction. I personally value them around 150, 160-ish. I didn't buy much of them. I would have, but I did not have the money at the time. That is how life works oftentimes. But it was an absolute great buying opportunity, and people were really out on it. So, but even if it only hit 200, it was still a bad year for them. Good to great to amazing companies still have bad years, and that is going to reflect in the stock market itself. Recessions happen, bear markets happen, we get too high on PE. I mean, we could run flat in VOO for a year. And honestly, we grow like normal companies grow, and we're still probably not crazy overvalued. We're probably valued in the historical average. I mean, here it says 25.5, which is way more reasonable. Let's just say we grew, let's say our PE is 20, right? And we run flat in VOO for a full year. That's kind of probably where we should be valued. Historically, S&P 500 is in that 16 to 20 range. Historically, I believe, maybe even a little bit lower. Yes, we get growth. Tech companies are growing crazy fast. A lot of growth is concentrated in a few companies that boost PE valuations. I understand that. My point I'm trying to make in this video, it's not fun to watch your stocks go flat. It's not fun to watch them go down. We need our stocks tied to what is actually happening, actual value, actual supply and demand, actual growth of companies. That is fine, that is normal. And when the market overreacts one way or another, if we're buying the S&P 500 at 35 PE, assuming retirement, it doesn't matter that much. Certainly with extra money we're investing, you can throw at something more conservative, a value stock, something like a Vici, something like an HCA. There's plenty of companies you can still find that are growing. Kroger, I was talking about them. No one really cares. 15 PE, they're doing very well in this bear market because they're cheap and they're doing fairly well. There's always opportunities, and then when we're down at freaking 12 PE because we're in a recession and you are fortunate enough to keep your job, and you're secure financially, you can put extra money in at those lows and you're going to do very well. So not that we can't take advantage of market reactions and overreactions, but it is a good thing. Believe it or not, it's a good thing that the stock market is tied to actual valuations, actual things that are happening in the companies, even when it isn't fun when it happens. So that's all I got for this video today. If you enjoyed, like and subscribe. I'll catch you next time.